I'm Haslinda. I'm an anchor for Bloomberg TV. A year and a half since the pandemic started and pent-up demand is back in a huge way, and nothing like real estate to tell that story. Prices globally are surging. Bubble warnings are flashing everywhere, something we've not seen since before the financial crisis. Record low rates, unprecedented fiscal stimulus, expectations of a strong recovery in the global economy, all contributing to that. Now let's get insights, explore opportunities. Tom Barrack, Barry, Sternlicht, thank you for your time today. Tom, let's start with you. When you look at real estate, so much money sloshing around, it looks like serious problems have really been averted. Did the Fed, did Congress, did Treasury get it right? What's your sense?
Haslinda, thanks for having us. I mean, I think, and Barry will agree that the amount of stimulus that's put into the system, the Fed's action in purchasing, interest rates, the proliferation of everybody having the same information and a flood of liquidity, and a focus on very minor risk factors is amazing. So too much of everything, readily available information, a decreasing edge for real estate generally. When you look at the bubble in the housing market, I'm sure we'll talk about it a lot. But this is nothing different. It's cyclical. Real estate always ebbs and flows with interest rates. It ebbs and flows with inflation. Those are things that we're all confronting at the moment. And real estate is a dinosauric asset class, right? It takes years and years and years to develop a real estate theme and an asset class, and we have technology going at warp speed. So you have kind of a mismatch. You've got technology 3.0 going to an industrial revolution 5.0, and real estate is going to have a hard time catching up. But too much money, too massive amounts of stimulus, probably to everybody instead of to the right people, and I think we're going to see inflationary consequences and interest rates rising as a result.
Barry, what's your sense? I mean, too much money sloshing around right now, too much liquidity, too much of almost everything. What do you think will happen when eviction moratoriums end, when mortgage forbearance end? Can we manage to limit human tragedy in the end?
Good morning. Hi, Tom. The Fed has overdone it, right? I mean, they've overstimulated, and they're actually looking in the rearview mirror instead of looking ahead. You know, we have over 9 million empty jobs in the United States now, and every business owner and every hotel we own and every shopping center and every restaurant can't find workers. It's actually okay because minimum wages will rise, but the incentive not to work, which is resulting from the overstimulation, and then trying to cure things wholesale with giant checks when really the private markets would do a better job of distributing capital, is a noble effort, but a poorly designed program. So, for example, in the infrastructure bill, everyone would agree that roads, bridges, and tunnels in the United States need $1 trillion of work. That would be a good investment. There'd be a return on that. The rest of it, which they're arguing about, is sort of, an idealistic view of the world. When you look at the U.S. economy, you have to remember the CARES Act at $1.9 trillion, more than $500 billion of that was going to state aid. The states haven't gotten the money yet, and the U.S. economy is booming already. I spend my winters in Miami. They're getting $1 billion from the federal government. They can do whatever they want with it. And you look at the economy, you also look at, Europe hasn't opened. So we have a booming U.S., a booming China feeding the U.S., and a closed Europe. So this is only going to get worse, not better. Inflationary pressures are going to stay in the system. Bottlenecks will stay around for a while. And that will lead to inflation. One thing I'll disagree with, Tom, is real estate was the last guy to play in a booming cycle. I mean, the stock market's filled with a casino and another part of the market that people pretend they know what to buy, to sell, the venture. Every day I review a company that's making $2 million that wants $30 billion valuation. Everything is stretched, and real estate at least has a yield, and yield in a yieldless world is super valuable. So, people can't sleep in their computer. So homes and multifamily are interesting asset classes. Travel will come back. Even if business travel is down, the denominator is going to grow. So you'll see increased travel around the world, and it's being reflected in the hotel stocks globally. Retail, it's catching a bid. People are getting out of their house. It's still a challenged asset class. Different experience in Europe. I'm in London. The stores are full with shops. There aren't people in them, but they're at least rented. And parts of New York or other cities in the United States. And the office markets are, they'll come back. I mean, the one thing I think about is I think about office being a dinosaur asset class, is that Amazon bought the Lord and Taylor building in New York City in the middle of the pandemic, and Google bought the St. John's Terminal building, which was another 2 or 3 million feet to go with their square footage they already have. So they're kind of saying one thing and doing another, and those are the tech leaders. So I expect you'll see these companies move into Europe as they build their hubs and they expand their footprint in Europe and in Asia. So I'm constructive on real estate. Things are pricey in every asset class, and I think real estate's just one of them. And your whole view right now is where are rates going to go? And obviously the 10-year 150, and you're like, why is it here? I mean, the economy is booming and inflation is rising, and the 10 years 150. And the only answer is there's just too much money holding, suppressing yields.
You're constructive, but you're also sounding a note of caution. I mean, what kind of opportunities are you anticipating? And linked to that, are you seeing distressed opportunities right now?
Well, you're seeing some miscapitalized entities that need capital. The owners held on through the pandemic, but now the banks are saying, okay, look, you've got to pay us. So you're seeing that. I think you'll see a lot of banks selling loans in the next year because the bank stocks are fine. The banks can take the hits, and they don't want to take the assets back. So I think you'll see some loan sales. I mean, our focus in the last couple of years has been some of the alternative asset classes, much like Tom, but multis and affordable housing has been a big theme for us. In Europe, we're doing apartments in Ireland for rent. We're doing some Spanish office at very cheap rents, that we think will rise. It's classic real estate investing. You're trying to find places like we built an office building in Miami in the pandemic and leased the whole building. So there are pockets of opportunity. Thematically, it's kind of hard, but you just find those markets that are strong and growing, Austin, Texas, and avoid the ones that are seriously at risk, like New York and San Francisco, for 100 reasons. It's not just rents, it's costs. And the costs are rising faster than the rents, and rents probably aren't going to rise for a significant period of time. So, we like hotels. I'm on my way to Copenhagen. We bought a hotel in Copenhagen. I'm going to go look at it in the pandemic from a distressed seller. So he's never sold some stuff, but he had to pay the banks, and he's selling one and now a second one of his properties. So I'll meet with him tonight. So there's things to do, but it's with a pin you find these opportunities. Not the other thing we've been doing is big public company takeovers. So the public markets exaggerated in the wrong direction. And while private individuals held on for better pricing and weren't going to sell into the pandemic if they couldn't, public companies the stock prices crashed. We just took private extended stay hotels. We bought 10% of the company at $9 a share, and we took it private at 20. So 2050, I think. So, there's things to do. We have a tender offer in Japan on a company. We're working on a company that's headquartered really in Germany. And we've announced a deal on we just took private a company in the UK that has a logistics base that was public. So there's needles in the haystack. There always is. Tom and I have been doing this for way too long, and you just got to look deep in the ocean. They're not floating. The good things aren't on the surface right now. Those are too obvious.
Barry's looking deep in the ocean. Tom, how about you? I mean, do you see the stress opportunities right now? And when stimulus is unwound, will it be orderly? How do you see this playing out?
No, I think to see the opportunities, you have to be at scale. You have to have a global company like Barry's that's just looking for an edge, so that instead of creating a theme, you find the salmon swimming under your feet, take advantage of that. But that takes professional players on a global basis in Main Street markets, capital markets, and all the asset classes. And quite honestly, I wasn't smart enough to do that. So 3 years ago,
pretty good.
but looking at who are the contractual obligors on real estate. Barry has an amazing hotel operation. The one we had lunch there together a few weeks ago. I mean, it's 9 restaurants, hundreds of rooms, condominiums, swimming pools. It's the best of the best, but it's an experience, and it's mark to market daily with the guests who are appearing or not appearing and spending RevPAR dollars. So 3 years ago, we looked and said, real estate is unbelievably competitive. It's yield based, and the world is going to total return, right? The top 15 tech stocks, much to Barry and my frustration, if we would have just invested in the top 15 tech stocks 3 years ago, our returns would have been much better in the near term than they are.
And I would have
today.
been in Central Bay next to you.
Yeah. Right, because the contractual obligors are the five. So we switched and said, we want to go to real estate of the future, which is infrastructure, right? It's digital infrastructure, radio towers, microcells, fiber, data centers, smart logistics, which is the infrastructure of the future and has counterparties of long-term obligors, the best credits in the world, who are now doing what real estate used to do, right? When we first started in this business, what you did is you went and bought a piece of land, you got it entitled for something, you got an architect and a contract, you spent a year developing the plan, you spent 2 years building it, you went to IBM or Xerox, you got a lease that was 200 basis points over the amount of money you were borrowing to build that, and you clip coupons for 10 years. And always the enemy was CapEx, right? The enemy in real estate in every asset class is CapEx, which is why digital is so interesting, right? The CapEx involved for radio towers or microcells or data centers or smart logistics or fiber are very limited, and the obligor is taking that risk over a long period of time. So we switched from legacy assets to digital assets, and fortunately or unfortunately, the pandemic came, which gave us this euphoric rise. So if you look at the old and the new world, there's plenty of opportunity, but you've got to be with pros like Barry. But the new world in technology 3.0 is something totally different. There were no digital REITs 10 years ago, zero. In the last 5 years, the top performers across the market in general have been digital REITs. So that is going to continue. 5G, if you look at where are people spending money, right? Where do customers spend? Housing, hotels, industrial, all the things that Barry is in for sure. And that takes massive scale and expertise to be able to produce the product to those people. If you look at 5G, just 5G, the rollout of 5G, so the internet of everything, the connection of everything. There's $580 billion that are going to be spent in the next 4 years just in infrastructure for 5G. So we go where the puck is going. That's being the total solution provider to all of those tech users and companies that are going to rely on bandwidth of one sort or another to deliver the product to disintermediate the buggy whip industries. Buggy whip industries will be fine. Great companies like Barry's will pick and choose where the edge was on that. But the wave, which is where we're going, is in the digital frontier. And real estate needs to be a partner with the technology companies to provide the infrastructure and the path for them to proceed.
Before I pick up on,
can I comment on? I mean, imagine there was a town of 100,000 people that was growing to 20 million, right? That's actually the digital space that Tom has so successfully pivoted into. It's really that kind of revolutionary change in the way we function as humans on the Internet of Things and the expansion of 5G and the data that will be needed, and the servers and the pipes to connect everything. You can argue about the slope of the trajectory, but it's probably higher than they say, or will grow faster because we've always underestimated. And it's global; it's needed everywhere. So, it is an asset class that we've pivoted into. We've done some data center stuff in London and in Virginia and some other places. But Tom recognizing that trend, he got. We say stay. I always tell our guys that the flow of capital can overwhelm fundamentals. And when you're riding a long-term trend, which Colony, Digital Bridge, I guess they'll call themselves soon, has moved themselves into, it's a very powerful wave, and because it's powerful, capital continue to flow there. The question is pricing, right? Pricing everywhere has gotten near and dear, and people recognize the opportunity. And so once you build the expertise, which they have in different verticals in the space, you can add, like we can in apartments, and we can to some extent in hotels. We can underwrite it differently. We have more confidence in our ability to operate it, in our margins, what we can do to occupancy, what we can do to credit enhancements, what tenants are looking for space. It is equivalent to ordinary real estate, or the bread and butter that is what most people think of as real estate. So it's a super exciting opportunity. And like everything, people know about it. So pricing is tough. So you have to be an expert to really compete.
When you talk about pricing there, when do you see pricing reflecting fundamentals? Because currently, of course, it's not.
I'm going to disagree. So when we started in real estate, there was only one place in the world you could buy buildings at like 3 or 4% yields and finance them at 1%, and that was Japan. And pretty much you can do that all over the world today. Cap rates, which seem very low, reflect really the cost of debt, and debt is really low. Of course, the German Bund is hovering around negative, and so like we're buying apartments, and you say you're getting positive leverage. So if you get, meaning the cap rate's higher than the cost of financing, and materially so. So we have a vehicle called a non-traded REIT, and we kind of target a 6.5 unleveraged, and we've bought $10 billion of real estate the last 18 months. And we can achieve that just buying generic apartments and levering them, because the Fannie Mae and Freddie Mac are fairly, they're aggressive lenders at tight spreads because everyone wants yield. So from that perspective, the day will come when cap rates might reverse. The day will come when multiples in the stock market will come down. You see companies trading at 300 times EBITDA. And, Tom and I don't know those multiples. We don't even know how to underwrite things like that. So, I think, and now they've stopped with EBITDA, and they just talk about multiples of revenue as if all companies were the same, and all companies have the same management team, the same competitive advantages, the same addressable markets. It's kind of, I kind of giggle because this usually means it's the beginning of the end. And Tom and I are definitely remember 2000 and 2001 when the NASDAQ dropped 82%. And, it feels like, I don't know, I could guess what would cause that to happen, but the trees don't grow to the sky. Tom and I have been through, I don't even know. Tom probably has been through one extra cycle than me. He's slightly older than I am, but we've seen a lot of cycles, the two of us, and they're all different. But this one, if the wilder the swing to the top, I mean, it is very much the Roaring '20s in the United States. I mean, spending up 22%. People are spending 13% ahead of 2019. And people are having a joyous, ruckus party. And the 20s were fun until 29. So, being the person who always worries about the downside and lets the upside take care of itself, I'm perpetually nervous, but I appreciate the asset class does not operate in isolation of the stock market, equities, and the credit markets. And investors are so hell-bent on thinking they're safer in credit. Well, when you're buying high-yield bonds with no protections at 3 3/4 and 4, you are taking a lot more risk than either Tom's digital assets or my apartments or whatever else I'm buying. So, I think it's all relative.
Let me jump in, because I think one thing that you do, which everybody should look at, is risk mitigation from experience, right? So Barry goes up and down the capital stack. So where you are, what we've learned through all these cycles is real estate is resilient. And it always comes back. So everybody says New York office is going to hell in a handbasket. It won't. It'll come back. It'll recycle. It'll take massive amounts of capex and it'll reprice. But if you look at the great credit providers, very a public REIT, taking equity-like positions for credit-like risk down the capital stack mitigates that risk of a pricing reorientation or the interest rate spike or an inflationary spike. Because remember, when inflation comes, it's actually good for real estate, because replacement cost becomes exponentially greater than where you were standing still. So it adds a buffer. But the credit markets, you can't feed your kids with residual pop on technology stocks that are producing no revenue, right? One of the most difficult things, I think, for all of us legacy players is a P&L doesn't matter anymore. Well, but it does matter, because at some point in time, you actually need cash in order to fuel the system. So that yield producing lower down on the capital stack in capital-like instruments, and a company like Barry's, a mortgage REIT, which has the experience to pick and choose across those classes at scale and produce real yield with a residual pop down the capital stack, to me is a major play today.
Tom, let me jump in here. A quick question about whether or not COVID has changed anything. I mean, prior to COVID, when international investors look at the real estate in the US, they're looking at gateway cities, the likes of New York, San Francisco, Boston, LA. Has that changed in any way with COVID?
I think that, the colloquial experience is right, that everything has changed and everything is changing, and the work from home mindset is here to stay. But we can't build cultures. You can't build a culture in your operation. Barry can't build a culture of excellence in his operation by only Zooming or Teams. So eventually, to me, the sociology of mankind comes back, and people want to be together, and this will be a memory and an ebb and flow, and we'll return to the median sooner than anybody thinks. That being said, right, the quality of life, kind of the COVID revenge that we're experiencing now, which Barry will be a beneficiary of it in his hotels, the travel and entertainment business will boom short term for what it is. People will be able to work and access secondary housing better than they ever did. But at the end of the day, I don't think things change that much. I think it just reprices itself. Will corporations go back to spending massive amounts of money on travel and entertainment and conferences where people are double dipping avocado dip with potato chips? I think that's going to take a bit of time. But the allure to life, even when the stimulus goes away, because as Barry was saying, I mean, Europe hasn't even, both he's in the UK, I'm in Europe, it hasn't opened yet. You have 350 million people. When this opens, along with China and along with the US, the boom is going to be incredible. So I think the rising ship continues to rise. What we all know is this ends at some point. There's an unforeseen intervening event.
I hate that part, Tom. I hate that part.
We have a couple of minutes left. I just want to touch on specs. We have to touch on specs, right? Everybody's in on it, politicians, celebrities, you name it. Barry, I mean, you're a spec sponsor. What do you think? Have we passed spec peak, you think?
I hope so. I mean, I've done 4, and 2 have found their targets. One's closed, one's on its way to closing. I have a big one and a little one. I just did that last week, actually. It's fun for me. It's a way to diversify I own Starwood Property Trust, which is the mortgage REIT that Tom spoke about. And then for, I think, 12 years, I haven't sold a share. So I'm quite long real estate, but I know a lot of people, and it's kind of fun. My family office really runs the SPAC stuff, and I just coach. I think the market hates doing anything in the right amount. So it went to wretched excess. And if you could breathe, you could raise a SPAC. There was a financial arbitrage that was being created by the selling of a warrant for free that actually had value. So you're getting more than $10 of value. That was the arbitrage that created the SPAC boom, the SPAC 3.0, whatever you call this, because you could buy the IPO, sell the warrant as soon as it was float, and you create the security cheaper than 10. And your worst case is you got 10 back. And when the hedge funds figured that out, all hell broke loose. They would buy a security from anybody. It was basically a free option, and the alternative was cash, and so you could earn better than cash just on selling the warrant as soon as it was detached from the stock. People understand that that's what drove the SPAC market, the buyer side. We raised $1 billion in our third SPAC. We had $9 billion of orders, and we never saw anything like it. 450 accounts. So people were slapping themselves on the back, had nothing to do with that. But now the market is much more discriminating. I think there are 400 people lined up at the gates trying to get a deal done. People who the market perceives as good fiduciaries, they're experienced deal people, they know how to look at companies. They seem to be getting there's a trickle of deals getting done. I hope it remains a trickle. I doubt it'll remain a trickle until the SEC sort of tightens this process up, because the projections that are in these, there has to be someone saying they're reasonable, and because I think they're really misleading investors. Not that it matters. I mean, investors don't care. They're taking bankrupt companies like AMC Theaters to $25 billion market caps in this new Robinhood world, and Reddit and market bets. So and people don't care. Clover Healthcare is basically a fraud, and it's trading at $16 a share, and it keeps going up. The more you say it's going out of business, the higher the stock goes. So the stock market is detached from reality, and I feel bad for my hedge fund friends because it is. I don't know how I trade it. I mean, I have some. I invest and I don't sell. I don't. But I mean, my housekeeper is day trading and getting rich, so we should invest with him.
But the bottom line is you pick the athlete, you don't pick the stadium, right? The difference between a Sternlicht sponsored SPAC and the Lordstown is 1,000 miles. So
Tom, we need to wrap up soon, but it would be very remiss of me if I don't ask you this question. I mean, there's so much questions about, what Mr. Trump is up to. Give us a sense of where he is, what he's doing now, Tom.
I actually don't know. I'm a viewer like we all are, and I'm always cheering from the cheap seats for whatever president of America we have. I mean, Joe Biden is doing a heroic job in what he needs to do, right? That playbook was written for a long time. It was 4 years of suffering for the Democrats. And so there's no surprise in what they're doing. And hopefully that works out well. President Trump did what he came there to do. It caused some unbelievably great results across the world and caused a great amount of frustration. So I look at it differently. I think the difficult thing for America is the spread between the haves and the have-nots and the difficulty that we have talking to each other with different points of view. So neither the Democrats or the Republicans or the Libertarians or anybody in the middle represents the heart and soul of America, right? The ability of a Barry Sternlicht to start from nothing and become one of the titans on a global basis is America. It's due to that DNA and the freedom and beauty of America. And I think that this adversarialness between all of them, including President Trump, will end up being a good thing because it'll force all of us as Americans back into our box and say compassion, conciliatoriness, a tolerance and a point of view. And what I hope for is that happens on a global basis. But it's unstabling to the world to have a Middle East policy carved in granite that evaporates in an instant and becomes a different Middle East policy. And this is the challenge, I think, for America, is have consistency with its allies. So I'm hopeful for everybody. I don't know exactly what President Trump is doing, but I hope for him the best. And I'm a big fan and rooter for President Biden and the Democrats to do the right thing.